This conference will now be recorded.
In our session today, we want to look at cash and receivables, cash and receivables. And you see the cash and receivables cycle. We start a company with money in the bank. We use that money to purchase inventory and set up accounts payable. We sell the goods on credit. We then pay for what we bought. And then we collect money to return it to the bank. And hopefully we have a cash balance. On the cash cycle, we begin with cash. We purchase on credit. We sell items for cash and credit account receivables. We have to pay the accounts payable, collect the receivables, and then return additional cash to the bank, hopefully with the idea that the cash is always growing. Keeping track of cash is critically important. And in a typical business, we're going to have more than one journal. We're going to have a sales, receipt, and cash journal. So all the sales and receipts are in one place. And then we're going to have a cash disbursements journal. So all the payments are in a different place. That just makes it easier in terms of no mistakes, all the sales transactions in one journal, all the disbursements transaction in another journal. We didn't post to the ledger to just that one ledger with items coming from two journals. And the process stays the same. We get the balances and we do a trial balance. But a separate cash receipts journal and a cash disbursements journal is very important. We're going to have daily cash sheets if we have cash so we can keep track of it. We're going to perform bank reconciliations because with a business, errors can occur. And so we want to make sure that there are no errors on our part by our employees or the bank. Then there's some accounting for petty cash funds. If you have small amounts, sometimes you keep cash on hands or you use a credit card to pay small purchases, because in general, you want to use a check to pay everything. You want to go through the cash disbursements journal and use a check, but for some small purchases, we set up a petty cash fund. Once again, maintaining daily cash sheets is very important because that cash sheet cash can be stolen. I talked to a banker recently, and the banker told me he fires one bank teller a month. And so, with that being the case, it's just very important to make sure that you're looking at cash, you're maintaining the cash, you're comparing the cash with the cash register. I know you should have this. I'm going to try to make it just a little bit larger. 14 with everything. Okay. Yeah, I think that makes it much easier to see in terms of this cash receipts journal, daily cash sheets to disbursements journal, and maintain those daily cash sheets and making sure you deposit the money to the bank in one deposit at the same time. Internal controls. Internal controls are all the process a company utilizes to safeguard its assets. So when you're running a company, you got people working for you. Or if you're working for a company with a lot of people, You got to safeguard the assets, ensure compliance with laws. And so the elements of control include a control environment, risk assessment, control procedures, monitoring, information, and communication. This has to be formalized and written down. Some key things you want to rotate people through duties. You want a separation of responsibilities, some sort of system of checks and balances. And anytime you look at an employee, you have to be studying your employees. If you see certain things, changes in lifestyle, uh, excessive tiredness, so you think they may be using alcohol or drugs, the missing documents, their gaps, they're going to come to work because they don't want to be found. Then you have to study those employees. So as a manager, you have to do that. We had a lot of setbacks in our system in the early 2000 area. And so companies just went crazy doing frauds. And I think that if you remember, we had the Enron fraud, but there are a lot of other companies also. And they would falsify their statements. So Sarbanes-Oxley was passed, and the purpose for passing Sarbanes-Oxley was to make it easier to sue the officers in the companies participating in fraud. So when frauds occur, the shareholders and employees lose out. Shareholders lose their investments, employees lose their job. So Sarbanes-Oxley was passed in 2002. We got vigilant. But then in 2009, the Stanford Financial Group in Houston committed frauds and took people's money again. And, you know, we stopped that. We're in 2020, probably have a lot more frauds that are in the process. People, you know, will always try to do fraudulent things. Why, for students, I tell you, you know, be truthful and honest. Because if you do fraudulent things as a student, then you do those when you get on the job. And as you get on that job and you see things happening, it's better to lose your job than go to jail. So always remember that. It's better to lose your job and go to jail. The bank reconciliation, we talked about this briefly earlier. You're going to reconcile your bank statements to make sure that the money is correct. The two aspects of working with the bank statement, there's the bank analysis. We look at the bank statement and see what's on there. And there's the company analysis where we look at our personal books. So there's the bank statement with the bank transactions, and then there's our books for what we show. For the bank statement, we look at the ending cash balance on the bank statement. And then if there are transactions that the bank doesn't have, such as deposits that we've made that they don't have, or if there's checks that we've written that they don't have, then we determine the correct balance. With our company, when that bank statement, we do a similar thing. We look at the cash that we show in our ledger and the checkbook. We see if there are any deposits the bank has made, such as interest that we don't have, and then we have to record it. And then we deduct debit memos, such as service fees, customer checks returned, things like that, to determine our correct balance. And a key thing is that for the company component, you got to make journal entries. If we get interest income, then we're going to debit cash and credit interest income. So we have to make journal entries for anything on the company's component. Let's look at a bank reconciliation situation. Sebastian Stevens, former student, he wrote this. He operated a successful business and he was banking with Chase. On April 30th at 12 o'clock midday, the balance per the bank was $20,000 and the balance in Sebastian's checkbook was $20,000. At 1 p.m., the bank posted the following. It added $500 in interest to Sebastian's account for interest income. It deducted $100 for service charge, and it closed the account. And when the bank statement came, it showed $20,400. Sebastian at 6 o'clock on that day, he made a deposit online for $30,000, for $3,000, excuse me. He made a cash withdrawal of $500 for weekday expenses, and he wrote a check for $1,500 to pay his rent. And Sebastian's checkbook showed $21,000. So the bank is showing $20,400. Sebastian's checkbook is showing $21,000. What is the correct balance? Okay, so what we're going to do, we're going to do our format. We're going to start with the bank. The bank balance showed $20,400. And we're going to jump to these transactions that Sebastian had that the bank didn't have. So Sebastian deposited $3,000. We're going to add that to the bank statement balance. And then Sebastian withdrew $500 for weekend expenses and wrote a $1,500 check for his rent at the end of the month. So we're going to subtract both of those. And when we adjust that bank balance, it's at $21,400. We add the $3,000 interest and the deposit online. We subtract out those payments the bank didn't have that we made after the bank statement date. And so our adjusted balance is $21,400. Now, according to the company, we had $21,000. We have to go up here and look at the items that the bank had and put those on our company's book and make journal entries for that. So for the entries that the bank gave us, we add that to our $21,000. And then for the service charge of $100, we subtract that. And so our adjusted balance on the books now is $21,400. So the bank show balance when reconciled is showing $21,400, and we are showing $21,400. We make journal entries for both these items on our reconciliation. Now, there are more comprehensive bank reconciliations, and so let's look at one for our A students because we don't want them to get it bored. So we have J.H.J. Roan Car Company. They deposited $100,000 into the bank, and they made the following weekly deposits: 20, 30, 40, 50, for a total of $140 plus the $100,000 beginning deposit. They wrote the following checks on these dates: 3, 5, 7, 10, 12, 16, and 14, 5, 12, 8, 2, 35, 4, and 8. So 15, 2, and 31. So the total checks written were $121,000. So for our checkbook, we showed an initial deposit of $100,000, weekly deposit of $140, checks written $121. So the ending checkbook balance that we had was $119. The bank statement comes and it shows the following. It shows deposits of $1,000, 20, 30, 38, 3 for $191. So when we get up here and check, there was that initial deposit of 100, then 20, 30, and we showed 40, but the bank showed 38 for that deposit. So there's a discrepancy there that we'll need to look at. And in terms of now, so as we look at this bank statement, we have to look at why it's 38. And of course, the bank gives us 3,000 interest. So it's total deposit 191. For the checks written, they have the checks from January 5th through the 27th. So the checks from 5,000 to about 15,000 are clear. But some of the latter checks, it appears that they didn't clear. So when we prepare this reconciliation, we go with the bank statement, 0. We look at their deposits, 191. We look at the checks that they paid, 89,000, the service charge. And so the ending balance for the bank is 101,000. When we get to the checkbook had 119,000. We got to add that interest income of 3,000 for 122. You got to subtract the service charge of 1,000 and then that deposit error for 2,000 for 119. And we want to see why that error was made. Did the bank make a mistake or did we make a mistake? And so when we go and do the reconciliation, the balance per the bank, add the deposit in transit, subtract the outstanding checks, the correct cash balance is 119 in both cases. Summary points on the bank statement, item on the bank reconciliation to the correct balance. Items on the bank reconciliation to the correct cash balance comes from the bank statement on the company's bank. Items on the bank's reconciliation comes from the company's cash records. Journal entries must be made for the items on the company's bank reconciliation as they are unrecorded financial transaction. So we debit cash and credit interest income, 3,000. We debit miscellaneous expense and credit cash for 1,000. Then for that error in the deposit, we're going to debit sales and credit cash and see what happens. So, students, we expect you to be able to handle this. And I think we have a little problem for you all to work on. Okay. Well, I mean, it makes more sense. Like what he said. Now, this is one that's a little longer. You just kind of say pause it in each paragraph and then go back. Good point. What? Well, I'm talking about for all the stuff. I'm sorry, don't blame me. Why not? Well, no real reason, I'm just saying that. I'll put it on this topic. Short slip in my brain. Which stood in the house to record. Well, I mean, if they're doing it in 4K. That's okay. Well, I don't have any technology with it. But I feel, well, I mean, he can record also just through the map and upload that to the 24 hours. I can show the screen.
Yeah, but I'm just saying, you can record through the Mac, and upload a video to other things at a much lower rate.
Yeah.
So I'm saying, because the Mac's not gonna make you do 4K. And I had no idea that was recorded in 4K. I didn't know that computer had 4K.
No, but it's not necessarily.
Like, they just have to record and then forget.
It's not full capable.
Yeah.
That's the way technology's going, but when I get to the pan, we're not on main lesson for two. You got to go on main lesson for one that's wrong. Then I'm done in terms of that. I'll say you over and over and over again. So that's what we walk about.
Well, that makes sense. Then just email a question. Wow, that's weird. Yeah. Still, I'm looking at what it was, I mean, that still is like, that's really quality. Yeah, well, I mean, now that looks like Grizzly Adams more too well than that one was.
Oh, I thought you were talking about, oh, you talking about that.
Yeah,
Oh, yeah.
that's the beard. I thought you were saying that the instant cut sound
This conference will now be recorded.
Okay, we have the statement of cash flow. And with the statement of cash flow, and I hope we don't have a big gap in terms of the break I took. This is that final statement that we look at, because we have to really make sure that the company has liquidity and can pay its bills. As we know, we discussed that when a company is started and it invests money into its common stock, the owners do that. The purpose of the company is to increase the cash through earnings. So that's the ultimate objective. And so revenues have got to exceed expenses and dividends for the cash to go up. And we'd like a company to show a trend of 3 to 5 years of good cash flow records. And the cash has to come from operations. Now, there are 4 components to the cash flow statements. There are 4 components. And I'll move these all down so they be together. The components are part 1, operations, part 2, investments, part 3, financing, and part 4, the change in cash. If we were looking at you personally, when you graduate, you'd like to have enough cash, say $100,000, to be able to pay on your student loans, to invest in additional assets here. Pay on your student loans and have cash left over. So that's what you would like to be able to do when you graduate. You'd like to have $100,000 in cash, buy some additional assets. That is why I go to college if you can't buy additional assets. Pay off your student loans and have cash left in the bank. The company operates the same way, and your salary would be equivalent to operation. A company needs to be able to generate cash from operations, such as Macy's selling its clothing, a rental car renting its cars, so that it can expand. The rental car company needs to buy new cars. Macy needs to have more stores or sell more online. Then it needs to, be able to pay off its debts and pay its owners and still have a positive change in cash. So operation equates to your salary. Investments equates to your going out and buying additional assets with your salary. Financing relates to paying off debts, and then the positive change in cash. So let's look at how we're going to prepare a cash flow statement based on what we've learned so far. Let's look at the steps in the preparation of a cash flow statement. First of all, we review all the journal entries. If a journal entry does not involve cash, it's not part of the statement of cash flow. So that's 11 through 17, whatever, is not part of the statement of cash flow. We can prepare a T account for cash, or we don't have to. On the left side will be the debit zone plus the beginning balance. Then on the right side will be the disbursements, and we determine the ending balance. But we have this template that I prepared in terms of the cash flow statement. So we do have this template. If I can get it a little bit larger, see what happens. Okay. I think we're okay with it this way. You'll be able to see it a lot better. We're going to prepare a statement of cash flow using this template. We're going to show how much cash came from operations, how much came from investments, how much came from financing, and the change in cash flow. So we're attempting to do the same thing. But the way we'll do that, we're going to go back to our journal entries. For journal entries where cash comes in, they're going to be on the left side. Journal entry one is going to be a cash flow from financing, because that's how the company was started. Journal entries 2, 3, and 4, and 5, if it's a short-term liability, are going to be sources from operations. Journal entry 6, cash from the sale of a long-term asset, will be in part 2. And then the cash flows from financing sources, either what we invested in a long-term debt. So remember, we want the cash to come up here. If we have cash coming down here, this is like an individual. You sell your car and go to Las Vegas, and you come back and you got nowhere to go to work. So when a company begins to sell its asset, long-term assets, that's a problem. It's supposed to sell its inventory up here. It's not supposed to be selling its long-term assets. Now let's look at the disbursements. In preparing the statement of cash flow, journal entries 7, 8, and 9 are going to be uses of cash. in the operations. Something you're paying your current bill. Journal entry 7, when we buy a long-term asset versus a current asset, it's going to be down here in investment. Then journal entry 8, when we pay a long-term liability, and journal entry 10, when we pay dividends, is going to be located here. So let's look at what we would do. We'd add up the journal entries in sources, get the total sources, we add up total uses and the net change. And as we know, we want that change to be positive. We do the same thing in the second section. We add up the sources and the usage journal entries, and we get the net change. We like this one to be negative because you're expanding. Here, we're going to add up the sources from borrowing and the sources from paying off long-term debt and dividends, and we want this to be negative also. But then this last number we want to be positive. So let's see how this template will work in the actual situation. And of course, at the bottom, this is the ending cash balance, which we want to increase. Suppose we had this statement of cash flow example and these journal entries, and we're told to prepare a statement of cash flow. We're going to look at each transaction and see if it goes on the statement. Contributed cash of $200,000 to begin the business. That's going to be a type 1 transaction. And so that's going to go type 1. So it's going to go in part 3 of the statement as a source. Purchase inventory account, it goes nowhere. So let me just go to the statement right quick. And let's go and put this first transaction in. And what I'm going to do, I'm going to copy this. And I'm going to paste it here. Then I'm going to clear everything out so we can start with a blank one. Then we always have our solution down there to look at as we work on our statement of cash flow. And let's just see if we can do one thing here. Okay, so this works out. If I can trying to get back over. I didn't quite line it up because what I was trying to do was to line problem up. Let's see if I try it this way, what will happen. Now it's going back the other way on me. I was trying to get this side by side. This side by side with this. Let me see if I can try it again. won't get this side by side for me. Well, we'll work on that. So our first transaction, we contributed cash of 200. This is a type 1, which goes in part 1. So we know that if it's a type 1, it's going to go in part 1, part 3. And so we're going to type it in here. So we contributed cash of 200. That's going to come right here. And of course, this is a journal entry 1. So we put the first one in journal entry 1. And of course, you can be referring to this in terms of where they go, but we're just putting them all in as we go transaction by transaction. Okay, purchase inventory on account got X. That doesn't go in there anywhere. Cash sales were 1,200 with cost of sales 600. We aren't worried about this part of it. We're just worried about 1,200. So since that's a cash sale, that's going to be a type 2 journal entry. Type 2 journal entries go in part, this went to part 3. This is a type 2 journal entry that's going to go into part 1 of the statement. So we get the 600, and that's a journal entry 2 for 600. So we've got 2 items in now. We contributed cash of 200. That's type 1, part 3. That's type 1 journal entry goes in part 3 of the statement. Then we had cash sales 1,200. Type 2 goes in part 1 of the statement. So this should be 1,200. Maybe I'll put some dollar signs by these to make it a little bit clearer. Okay, let's go to our next journal entry. Sales on account were 800 with cost of sales 400. X, this doesn't go anywhere. Purchase supplies paying cash. Now, that's a use of cash. So that, of course, is going to be in this use side. And we pay, we buy an asset, a current asset, that's a journal entry 7. So this is type 7 journal entry. And a type 7 journal entry is going to go in part 1. Now, if it's a use of cash, those journal entries 7 through 10, they're going to be on the use side. So they're going to be on the use side. So this is a JE7. And we purchased the supplies for 100. So we put in each transaction a certain place, and that's going to lead us to the statement of cash flow. paid salaries of 200. When we pay an expense, journal entry 9, that goes in to operation. So paying salaries, that's a type 9 journal entry. And that's going to go in part 1. So we're going to take the 200. So we're going cash journal entry by cash journal entry. If cash is not involved, we skip it. Okay, purchase equipment costing 600, paying cash of 200, and signing a long-term note for the balance. We purchased equipment for 600. So that's going to be purchase a long-term asset. Journal entry 7. That's going to be in part 2. But then we use debt to help buy this asset. And since we want to reflect all that, the cash is only 200, but that 400 loan amount that we took out is going to come in here as a journal entry type 5, where we got cash with a long-term loan. So we bought the equipment. It cost 600. We paid cash down 200, and we took out a loan for 400. So let's look at how we're going to do that. We first of all are going to get we have the purchase of an asset. Okay. And so we're going to show the total 600 here. So this is purchase of an asset. The asset was purchased with a loan also. So we will kind of say this is a journal entry 7, purchase of a long-term asset. But we want to show the total amount of the asset. Okay. And so the cash paid was 200. So the loan is actually, so the loan taken out on this asset is going to be 400. And so that's going to be a journal entry 5, type 5. So we're going, let's get this to the end here. So we have a journal entry 5. And that's going to be, and so what happens here is that we buy the asset at 600, and we want to show how much we paid all total, because this is a long-term asset. We put over here the loan at 400 as a source, so we net back to 200 as the actual cash expenditure, but we're showing it 600 for the purchase, and then 400 for the loan. So it nets back to the 200. A little different, but this is more useful information for us. Okay, so we have this one taken care of. So several types involved here: purchase of an asset using cash, and purchase of an asset using debt. So So if I want to put types here, let's just put 8, 7 plus a type 5. So and we split it up. So we'll work with this and we'll get through that in terms of how we do that. Paid on accounts payable $700. That's payment of a liability. So that's going to be the current liability. So it's going to be journal entry 9. And let me just also put up here part 2 and part 3 in terms of the location. So we have 2 journal entry types and 2 locations. So we'll see that periodically. Okay, when we paid on the liability, we said that was a type 9. And since it's a current liability, it's going to be in part 1. That was 700. So we go here, journal entry 9. Okay. Let's move now to okay, that's where that comes. Payment on the account payable is a type 8 payment of liability. So when we pay on the account payable, is actually a type 8. And when we pay the salary, that's a type 9. Okay, back on track. Collections on account receivable, another cash transaction. That, of course, is a type 3. And so that's going to go on part 1 of the statement. Because journal entry 2, 3, 4 go in type 1. So we're going to get that collection of 500. Okay. Moving back, we're just going transaction by transaction. Paid on long-term note. That's payment of a long-term liability. So that's going to go in part 3 of the statement. And that's a type 8. And that's $200. And so if it's a short-term liability payment, it's up here in 1. If it's a long-term, it is in part 3. I don't know why it's trying to do this to me. This should be a 3, I guess, if I expanded it, backed it up a little. So just remember that this is a 3. Move these over. I was going to move over. I guess Word likes to act up like this sometimes. Get this over here. Fine, it's moving over. Let's see if it will go over now. Yeah, it's like better. Okay. So we got our 200 taken care of. Now we have transaction 11, paid dividend. That, of course, is a type 10. And that's going to go in part 3. Dividend was $100. Now, supplies on hand, an adjusting entry, so we know no cash involved, X there, depreciation expense X. Then we sold the equipment costing $250 for 100. And so this is type 6, and that's going to be in part 3. So this is a type 6. Therefore, it's going to be in part 2, excuse me. So whenever we sell our assets that aren't required for resales on inventory, we show it separately because we're going to, want to let you know, should be letting you know what's happening with the company. So we got 250, but if you're selling your assets, your operations, that can be a problem. So this is journal entry 6. And we got 250. Okay, so let's look at what we're going to do at this point. Calculator here somewhere. Okay. To determine what's happening, we add up in each area sources and uses. So if we add up our sources and operations, 1, 2, and 5, we're going to get, we add all of these up, that's going to be 1,700. Then we add these up, 700, 200, and that's 1,000. So we had sources based on the journal entries of 700, uses of 1,000. So our net change and the amount of cash provided by operations $700,000. So I just sort of put some additional zeros in to give you a better feel for it. From investments, we had 600 that we bought, 250 that we sold. So that's going to be 350. So our business had in the second area investments, and because the uses exceed the sources, we're going to put this in parentheses. So when the sources exceed the uses, net change is positive, but if the uses exceed the sources, it's negative. Finally, we go to the cash flows from financing. And we find that we have 600 in terms of sources, and our uses and so our net change in cash from operations was 300,000. So when we look at the change in cash, 700 from operations and 300 from from investments, borrowing, financing the company, and then 350 in expenditures, then our change in cash should be 650, I believe. Let's see, a million minus 350 equals 6, so 650,000. So as we look at this company, we prepared a statement of cash flow, which showed how much came from operation, where it's supposed to come, how much came from investments, which should be negative, and how much came from financing. And sometimes it's okay to borrow as we go through, but eventually we want to pay these loans off. But if you have a company and this number is negative, that's a problem. It's like the individual having cash with not having cash but no salary. The other person get a bunch of student loans and has cash that way. Well, you know the loans got to be paid back. So anytime a company does not have a positive number here, it's a problem. The cash flow from investments is negative, which we like to see. And then, we eventually want to be paying off debts. You got student loans, you don't want to continue to get them. So this is how we do a cash flow statement. And as you practice on these, you'll be able to do them. You look at the transactions, you X out the ones that do not involve cash. And then for the ones that do involve cash, you place it on that statement where you got the template that tells you where each journal entry type goes from 1 through 10, which is all we're working with here. So any transaction not involved in cash, not on the statement. Then we look at the transaction, make that determination, put X's by the ones we're not going to use. Then we prepare our statement. So this is a statement, this is that final statement that we said we're going to learn how to prepare. So now you know how to prepare. So here's a problem for you to work here. Statement of cash flow for 1. So work on that statement. And then here's 4.2. Work on that one. And then for the A students, you got 4.3. So when we test next examination, some students will have 10 transactions and others will have 20. Okay, so we are going to stop there today. We've covered a lot. Work the problems, and of course, we'll go over this in class, but you have to pre-look at this. Attempt to work this first problem that we have, and we'll cover it in class. And we'll go from there. So it's a change, it's a difference, but it's an important statement, and we will talk about it later. So it's a difficult statement, but it's very important to determine whether a company is going to be liquid and whether your investment will be solid. That's our final statement. And I look forward to working with you on this further. Thank you.